Alright, let's be real. You need to stop looking at market cap. Seriously, it's one of the most misleading, distracting, and frankly dangerous metrics in all of crypto, and it's probably costing you money, while thousands of investors are glued to coin market cap, hypnotized by billion-dollar valuations that seem to pop up overnight. The pros. The people who are making life-changing returns. They're watching something else entirely. They're tracking one simple number. A number that cuts right through the hype and the stotsers. In this video, I'm going to show you what that metric is, where to find it, and how you can use it to see a blockchain's future before the rest of the market even has a clue. If you're new to crypto, someone probably told you to look at two things: market cap and total value locked, TVL, and it seems logical, right? Market cap is just the coin price times the circulating supply. Big number must mean big project, right? Wrong. Relying on market cap is like judging a car by its shiny paint job while ignoring the fact that it has no engine. Market cap is a reflection of price and hype. It tells you nothing about the health, usage, or real value of the network itself. A project can have a massive market cap with a tiny user base, purely driven by a speculative frenzy. It's a measure of perception, not reality, and perception can change in a heartbeat. So, the slightly more advanced investor says, okay, fine, I'll look at TVL. Total value locked measures how much money is staked or locked in a DeFi protocol. That has to be better, doesn't it? It shows people trust the platform enough to put their money there. And yes, it's a step up, but it's still full of holes. TVL can be easily gamed. A project can offer absurdly high, unsustainable rewards to attract what's known as mercenary capital, funds that pour into farm rewards and then vanish the second those rewards dry up, causing the TVL to collapse overnight. We saw this with the vampire attacks in DeFi's early days, where new protocols would literally suck the liquidity out of established ones with short-term bait. Plus, TVL is directly tied to the price of the assets locked in it. If a network's token price doubles, the TVL can double without a single new dollar or user entering the ecosystem. It's a measure of parked capital, not genuine economic activity. When you rely on these metrics, you're constantly looking in the rearview mirror. You're always late to the party, buying the top of a hype cycle, and then you're left holding the bag when the narrative shifts. You're watching the scoreboard, not the players on the field. So if market cap is just for vanity and TVL can be a trap, what should we be watching? What's the one metric that shows real, organic, and hard-to-fake demand for a blockchain? It's transaction fees. I know what you're thinking. Fees. Aren't fees a bad thing? Don't we want low fees? And, for a user, yes, low fees are great. But as an investor, as an analyst, the total transaction fees a network generates is the most powerful and honest signal of its health. Think of a blockchain as a digital city. The transactions are the commerce, the cars, the people moving through its streets. The transaction fees are the tolls they're willing to pay to use the city's infrastructure. A city with no traffic and no tolls might be cheap, but it's economically dead. A bustling city with traffic where people are willing to pay for priority access, for prime real estate, for business to get done, that's a thriving metropolis. Transaction fees are the blockchain's revenue. They represent the sum total of all activity that users decided was valuable enough to pay for. Whether it's a DeFi trade, an NFT mint, or a stablecoin payment, every single paid fee is a vote of confidence in the network's usefulness. Unlike raw transaction counts, which can be spammed with millions of worthless transactions, fees have a real economic cost. It's expensive to fake. And unlike TVL, fees represent active ongoing demand, not just passive, parked money. It's why major research firms and analysts often point to transaction fees as a top fundamental indicator for measuring real economic throughput. High and sustained fee revenue tells you one critical thing: the network has found product market fit. It means the services on that chain are so valuable that users are willing to pay for them, even when cheaper options exist. That is the ultimate sign of a healthy, growing ecosystem. This isn't just a theory. Let's look at the proof. Case Study 1. The Ethereum Fee Engine. For years, everyone complained about Ethereum's high gas fees. They were seen as a bug, a failure of the network to scale. But for an investor, they were a blaring signal. Those high fees proved that Ethereum's ecosystem, its DEX, lending protocols, and NFT markets, was so valuable that people were willing to pay $50 or even $100 for one transaction. This relentless demand, shown by billions in fee revenue, is what cemented Ethereum's dominance. Now we're in a new chapter. With the explosive growth of Layer 2 scaling solutions, the Ethereum ecosystem is handling more activity than ever. We're talking a combined 10 million plus transactions a day across the main chain and its L2s. While Ethereum's mainnet still processes the highest value transactions, the real story is on Layer 2s, where fees are often less than a penny. For investors, the thesis has evolved. It's no longer just about mainnet fees, but the total fees generated across the entire Layer 2 ecosystem. That's where you follow the growth. Case Study 2, the Solana High Volume Model. Now let's look at the other side of the coin. Solana. Solana was built for speed and low costs, with fees that are often fractions of a cent. A naive analysis would say, low fees, bad investment. But that misses the whole picture. Solana's strategy isn't about high fees per transaction. It's about massive transaction volume. It's the Walmart model versus Ethereum's luxury boutique. Throughout its growth in 2024 and 2025, we saw a steady climb in its daily users and network activity. And while its daily fee revenue of around $1 to $3 million is just a fraction of Ethereum's, the important signal was the consistent upward trend. That steady growth in total fees, even from a low base, showed that its ecosystem was attracting real, sticky users, signaling its comeback as a major player long before the price fully reflected it. Both models are valid, and both are revealed by tracking total fees. How to use this like a pro. So, how do you actually put this into practice? First, find the data. Websites like Coinmetrics, Glassnode, and Dune Analytics have charts on daily transaction fees for all the major blockchains. Don't just look at a single day. Look at the trend. Is the 30-day moving average of fee revenue going up and to the right? That's a huge bullish signal. Second, compare the networks. Who's number one in total fees paid in the last 24 hours? Who's number two? Which chain is growing its fee revenue the fastest? This gives you a real-time leaderboard of where economic energy is flowing. For instance, seeing a new Layer 1 consistently break into the top 5 for daily fees is a massive indicator that it's gaining real traction. Third, add context. A sudden spike in fees might just be a temporary, one-off event like a popular NFT mint. What you're really looking for is a sustained rising floor of fee revenue. This indicates a growing base of everyday usage, which is the foundation for long-term value. If this just gave you a whole new lens to see the crypto market through, and maybe saved you from getting burned on the next hype coin, do me a small favor and hit that subscribe button and turn on notifications. We go deep like this every single week. For years, the crypto market has felt like a casino. We've been distracted by soaring market caps and bloated TVL figures trying to guess which story will grab the crowd's attention next. But you don't have to guess. Now you know what the pros are watching. You're not flying blind anymore. Transaction fees are the ground truth. They are the pulse of a blockchain, a direct measure of its economic heartbeat. They represent real users doing real things and paying real money to do them. While everyone else is chasing shiny objects, you can now pull up a chart, look at the fee revenue, and see the truth about a project's health. You have an edge now. You can tell the difference between a digital ghost town and a thriving metropolis. You can spot growth before it's priced in, and protect yourself from projects that are all talk and no substance. You are no longer part of the crowd, you are an analyst. And now that you know how to measure the health of one network, the next step is to layer this data with other signals to build a full trading strategy. In my next video, I'll show you how to combine fee trends with stablecoin flows to spot incredible entry and exit points. You won't want to miss it.